Hey, good evening, everyone. Good evening.
Good evening.
Good evening.
Evening,
Good
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 evening,
evening.
evening,
Professor.
Professor.
Good evening,
How are you?
President.
Oh, how are you, Jimena? How are you, Serena? How are you, everyone else? Now, we are done with the first topic. So we're moving on today. So we are moving on to uh, the second topic. I believe the second topic folder is open. I believe this, yeah, this folder is open, I believe. No, not, what am I doing? And yeah, topic two folder has been open since uh, for some time, right? Actually, this is your current main lecture, right? Current and active. So you must be caught up all the way to this. And everyone should be aware that the announcement went out already some time ago about the quiz one. I believe it went out. Okay, there it is. That was posted on last Friday. So it's been out there for a while. Okay, it looks like it's not exactly in order. This was sent out on 4th. I don't know how many people went to the Moody's internship information session. So you have it's starting from this Friday and due Sunday, right? So it's basically the first topic, right? So far, that's all we have covered. Us in the assignments, yeah, it's not visible yet, but it's gonna become visible uh, from March 11th. Okay, so we are in the cash flow statement, right? Or cash flow analysis. So and of course you need to download this file, download that file, right? And then cash flow statement, right? Also known as sources and uses of cash or statement of changes in financial position. Okay, let me get rid of that. No, I will need it. Why did I close it? Whiteboard. And you guys have Monday. This must be yours, right? I'm gonna get to that later. So as I said, I've been telling you as we started on the topic one that income statement and balance sheet are primary statements, primary, right? And cash flow statement is actually derived. Calling it secondary statement may not be appropriate because it sounds like it's less important. No, it's not less important. Uh, but but it is secondary in the sense that the data uh, uh, for the cash flows analysis is derived. We get the data from data for cash flow analysis from the income statement and the balance sheet, because it's based on the income statement and balance sheet. So it shows where money comes from and where it goes to, right? So it's developed from two balance sheets and an income statement. Yeah, I've been telling you, we need two balance sheets and one income statement. I mean, two balance sheet means, at time 0 and time 1. So at the beginning of the year, or, it doesn't have to be an year, but, basically, the beginning of the cycle and the end of the cycle, right? And then, of course, income statement is always, as of the end of the cycle, right? It analyzes where money has come from and gone to by adjusting the net income for non-cash items. Yeah, think about it. Net income, net profit, is not necessarily always cash, right? Remember, because revenue, a lot of revenue can be accounts receivable, right? A lot of revenue can be accounts receivable. Right? A lot of, oops, not that one here. A lot of, profit. First of all, before profit, of course, don't do that. Right? We all understand, of course, revenue is the income statement line item. Revenue belongs to the income statement. It doesn't belong to the balance sheet. And a lot revenue can be it can be cash or accounts receivable, right? In other words, credit sale. So if it is, in the cash flow statement, this is not cash yet, right? So cash flow statement is basically, correctly, of course, from revenue, and then finally it will have to go to we'll have to arrive at net profit. So if a lot of revenue was cash and a lot of it is also accounts receivable, I should promissory notes and accounts receivable, right? And then if that's the case, net profit will also include a lot of cash, some cash, and some, promissory notes. And accounts receivable. Right? And the problem is, if it is still accounts receivable and promissory notes, right, cannot be used for paying. Cannot be used to make payment. and the like payments. These are like short-term payments, right? Short-term payment obligations. These are short-term payment obligations. Right? Which are basically, the current liabilities line items, right? And if you fail to make those, current liability payments, then that's default. If you default on that, that can lead to bankruptcy. So that's very important. Of course, before you arrive here, right? Before you arrive here, right? Before you arrive, net profit. What's going on? Before you arrive, net profit, right? All those payments must have already been made, right? Must have already been made. Now, so the point is, that's what is meant by adjusting net income for non-cash items. In other words, accounts receivable, right? Promissory notes. Analyzing changes between beginning and the ending balance sheet, right? Time zero time. Let's begin with some, personal finance examples. So let's think about buying a car on credit, right? So Joe Jones is buying a car. His income is 50K, right? His expenses are 40K. So his net income is 10K. So this is personal case, right? That's why you cannot call this net profit, right? That's why I've been telling you in the income statement, they keep repeating the word income, over and over. And I told you that's not right, to call it, operating income, net income. It's better to call it operating profit, net profit, because it's business. But I told you, accounting has its own excuse. Accounting has its own excuse for that, which is, if it is a personal case, then you cannot call this profit. So there's income minus expenses, and that's net income. If this net income is cash, wonderful. But most likely cash, because it's a person, right? A person wouldn't have accounts receivable, right? Or promissory note. So and let's take a look at his assets. At the beginning, he had the assets of cash in the bank, $10,000, right? Cash in the bank of 10,000. He didn't have a car at the beginning, so total assets 10,000. If he buys a car, that will be an asset, because of course, in a personal case, the car isn't even business. You cannot even subtract this. You cannot subtract it as even business expense. But but if you're self-employed, the car can be declared as his business asset. If he when he buys a car and the car is $30,000, right? He will have $30,000 as physical asset, right? Fixed asset, and the cash liquid asset increased by 5,000 by the end of the year. I don't know why, but it will be explained. So total assets at the beginning was 10,000, but at the end of the year, 45,000. Liabilities and equity. At time zero, he had no car loan, but by the end, he bought the car with the $25,000 loan, right? And the $20,000 equity. The car itself is 30,000. So think about it. He had, his net income was 10,000. With his net income of 10,000 and loan, right? The car loan of 25,000, he could have bought the car, right? And then so at the end, total assets, right? Total liabilities and equity. At the beginning, it was 10K, but at the end, it was 45K. Okay, so this is the income statement and balance sheet. Now let's trace the cash flow. There was a cash income of 50K. That was a cash income of cash of 50K, right? Where did that 50K come from? He had, cash income right there from the income statement, right? And then cash used for living expenses, yeah. And, net source of cash from income, 10,000. Okay. Use of the cash to buy car, 30,000, right? That's negative because you have to subtract it. But the source of the cash from the loan, 25K. So net cash flow will be 5K because, from 35K, 30K subtracted. Finally, we need to reconcile these differences. So reconciliation. First, beginning cash balance, right? Begin cash balance here, 10K. Net cash flow, 5K. So the ending cash balance is 15K. Okay, so think about it. That exactly coincides with this. In other words, at the end of the first year, you have total assets of 45K, of which 30K is the car, fixed asset, right? And 15K is cash. So 15K, right? Okay, so this is simple enough. I mean, this example is simple enough. But then let's also think about, the next example. Take a look at the next example. Sally Smith, buying and selling cars, right? So she's selling an old car and buying a new car. Okay, so first let's take a look at the income statement and balance sheet. Her income was 60K. This is cash, of course, because it's personal. I mean, individuals do not have promissory notes, or there is no reason you would be holding a promissory note or invoices, right? Or the accounts receivable. And the expenses were 62K. So obviously she lived beyond her means. So her net income is negative 2K. Looking at the balance sheet at the beginning, she had already in the bank, she had 6,000. She had a luxury car, which is a fixed asset, right? 20K. But at the end, you can see, oh, she swapped her luxury car with an economy car. She sold, luxury car and bought an economy car. So at the beginning, no economy car. At the end, no luxury car, but an economy car. Total assets at the beginning, so there was 26,000 in total. And the cash in the bank at the end, she drew down on the her cash in the bank, so 1,000 left, and her fixed asset, the economy car, 9,000. So total will be 10K, right? And her liabilities and equity, looking at car, she got the car loan of 14K. I mean, she had outstanding car loan, because this is the car loan that she had previously got to buy this car. So she had car loan outstanding at the beginning of the year, right? 14K car loan. She had the equity of 12K. So then, that adds up to 26K. So look, the balance sheet must balance out. Balance sheet must balance out. 26K, 26K, balanced out. And then at the end, she doesn't have car loan anymore, because she sold a car. She paid off if she got 20K, obviously, with that she paid off her car loan, right? The equity at the end, 10K. So let's, basically cash flow statement will explain what happened to the equity, what happened to it. And then total, so at the end, total assets is 10K. So let's let's analyze what happened. Her cash income was 60K, cash used for living expenses, yeah. And net source of cash from income is negative 2,000. The source of cash from selling old car, yeah, 20K. Use of cash to pay off a car loan, 14K, right? Everything in the parentheses is negative, right? Your, cash outflow. And then she used use of cash to buy a new car. New car is 9,000. So so think about it. All of this will, if you add them up, you end up with 5K, negative 5K. And then obviously this negative 5K must have come from somewhere. And that 5K explains the decrease in your cash balance. You used 5K from your existing cash balance in the bank, right? You drew down on that. So using the beginning cash balance, right, from the cash balance, net cash flow of net cash outflow of 5,000. So you arrive at the ending cash balance of 1,000. Ending cash balance of 1,000, right? So this explains, the change in the this explains the change in your asset balance sheet position, asset position in the balance sheet, right? So here's the summary of how we look at cash. If assets increase, right, you have to use cash. If assets increase, you have to use cash. So that means cash goes down. You understand? You have to use $5,000 of cash to buy some asset worth $5,000. In our example, part of this 9,000, right, came from your existing cash balance, right? So when asset increases, cash balance goes down. Asset increases, cash goes down. Asset decrease, cash goes up. Why? You sell car, right? You sell old car, cash comes in. It's the source of cash, right? Cash balance goes up. Liability increase, that means debt goes up. So debt, if the debt level goes up, that sounds like a bad thing. But from the cash flow perspective, it's the source of cash. You borrow, and there's cash. Debt decrease, liability decrease, that's use of cash. Cash balance goes down, right? And all these cash flows are, generated and used in these activities. All businesses are engaged in three types of activities: operating activities, investing activities, and financing activities. And they are sources of cash flow. Operating activity, it says day-to-day activities, but what it means is, income statement. What's going on in the income statement? That's operating activity. Remember, I told you in the income statement. Let me see if I can make it smaller. Maybe 85. I told you from here, income to EBIT, right? That's called, that's operating activity. Right? That's operating activity. Just verbally, saying day-to-day operation. No, that's very disappointing. I mean, to explain it like that, that's very day-to-day activities. That's very disappointing. For me, it's very disappointing to say, day-to-day activities, because it's open-ended. That explanation, that kind of explanation is open-ended. I don't like anything open-ended, right? Anybody just adds something to that, whether they are well informed or not. They just add something to that. Makes it cloudier, more and more cloudier, right? When uninformed people add their opinions, it just makes it more chaotic. So I don't like open-ended, answer. That's very disappointing. But this is very closed-ended. Nobody can dispute. This is what operating activity means, income statement to EBIT, the activities involved in this process, activities involved in this process, income state, from income and expenses arrive, you subtract expenses, of course. So what are the activities, involved in it? This sums it all. Of course, the first activity is, of course, sale, because there's sales revenue, right? And this is not an activity, but passive income, like investment income. It's not an activity, but you receive investment income, and you pay out CGS, you pay out operating expenses. So these are the activities are involved in it. And you arrive at EBIT, right? That's operating activity. And then investing activity. And investing activity and financing activity may seem, something, comparable. No, they're not. They are clearly different. because investing means, investing in fixed assets, right? Firms buy or sell fixed assets that enable it to do business, long-term purchases and sale of financial assets. These are investing activities, right? Long-term purchases. Long-term, what's a long-term purchase? Usually, fixed assets are long-term purchase, right? A sale of financial assets. If you sell stocks, if you sell stocks, that's sale of financial asset. And stocks, that's kind of okay. That's kind of I got mixed up. Not stocks, but like this is a little weird. So, I think sale of financial assets. This must be removed from this. Sale of financial assets. Sale of capital assets. It should be changed to capital assets, right? Sale of physical assets. For example, you get rid of buys and sell fixed assets, right? So if you buy production equipment, right, it's an investing activity definitely, and cash is being used. But if you sell old equipment, if you sell, this equipment is now, we don't want selling that, production equipment, old equipment, that generates cash. Sale of financial assets, this is wrong. That's financing activities. So this is wrong. I don't know why it's financing activities. It's basically borrowing money, paying off loans, sell stocks, pay dividends. That's financing activity, right? In other words, borrowing money means what? Selling bonds. When we say borrow money, it's not only it doesn't mean the bank only, right? You borrow money by selling bonds, and you raise capital by selling stocks. Now, financing activities, think about it. Financing activity is what makes the investing activity possible. Okay, now think about it. Oops. Why is this thing so big? So think about it. Financing activity, operating activity, right? First. Oh, what's going on? Operating activity generates cash, right? Or capital, right? Cash or capital. 2, financing activity also generates cash or capital. And then what are these used for? It is used for funding the investing activity, right? Makes sense? So this is what they call, like racetrack diagram or something like, maybe it's not a racetrack diagram. So take a look at this. First, Operating activities, you will, through operating activity, you will generate cash, right? Because the net profit, right? That cash feeds into investing activity, purchase fixed assets, right? Also, financing activities, right? You sell stock, you sell bonds, and then the stock payment of, for stocks, right? The payment you received, the capital you received through stock, that cash goes to, right, investing activity. Some of it goes to operating activity, right? It goes to, with that capital, you buy inventory, right? And by buying inventory, you will have to pay the vendors, so that cash goes to the vendor, and also that pays the wages, right? Right, and then that cash turns that raw material, that inventory, that raw material turns the raw material into the product. That product gets sold, right? And some of it is cash, some of it is receivable, like accounts receivable, right? Credit sale. And then when you collect the receivable, that turns into cash. That cash goes back into, right? The investing activity. Some of that cash goes to paying dividends, right? And of course, some of this cash goes to paying taxes. Also, when you sell bonds, that's debt, right? Bonds, a source of cash. It comes in, and then it goes to acquiring fixed assets, or some of it goes to fund. Some of it goes to fund the operating activity, right? Buys inventory, right? It pays wages. It funds the production of the product. Products get sold, right? Turns into cash, and some of it is receivable, right? And once the receivable is collected, right? Cash is collected from the receivable. It goes back here, and that goes into repaying debt or paying interest, repaying debt or paying interest, right? So this is the cash cycle, right? Also, they call it, they use, racetrack. Why is it like this? They use racetrack diagram. First, this cash comes from what? It doesn't show, the source of cash, but, this cash comes from financing activity, right? This cash comes from the financing activity. Sale of stock or sale of bonds, and then that cash goes into the inventory, pays for the inventory, raw material, right? Pays for the labor, and then turns into the product. I mean, if it is not manufacturing, if it is, retail, this inventory is already finished goods, right? So they get sold, and when they get sold, you receive either cash or receivable. If it is, accounts receivable, then it will turn into cash eventually, and that goes back into this cycle. Some of it goes to pay, for assets, acquiring assets, right? Investing activity, used for paying taxes, and whatever is left is, profits, right? That's called the racetrack diagram because it looks like a racetrack, of course. Now, so now we extend our example to a bigger scale, corporate example. So again, we need to look at the balance sheet, 2 years, right? Um, December 31st, 2021, December 31st, 2022, or something, right? Two balance sheets, an income statement, right? And from here, you can tell cash increased by 400 over 1 year. Accounts receivable decreased. Inventory increased. This is, obviously, increase in inventory is not a. This is unsold ending. This is ending inventory. Clearly, more ending inventory than the beginning inventory. Not a very good sign. Current assets increased. Fixed assets increased. Gross fixed assets. Accumulated depreciation was 1,000. More depreciation. Net fixed assets 3,000. Everything is million actually, like 3 million, 4.5 million. Total assets increased. That's a good thing. Liabilities. Oops, what happened? Accounts payable increased. If accounts payable increased, cash has if accounts payable increased, cash has increased. That means cash has increased, right? Remember, instead of using cash to make payment, right? They used something else. They used accounts payable. They used, something like promissory note. So they preserved cash. More cash is without. Accruals, decreased. Current liabilities increased. So that's a source of cash, actually. Long-term debt increased. That's also a source of cash. Equity increased, source of cash. Total capital increased, source of cash. From all of this, we can tell cash increased. Now, balance sheet must balance out. They balance out. And let's take a look at the income statement. Sales revenue, CGS, right? They sometimes, I don't understand why. It's both are possible, right? You can call CGS, or you can call COGS, cost of goods sold. But I prefer CGS. Why? It's like, look, it's like saying this is like USA, right? But this is like saying USOA, right? Is all necessary there? I mean, we already know it's cost of goods sold. We already know it's United States of America. We just don't use of there, right? In the acronym. I prefer this, clearly. And it always reminds me of, this is just, I'm digressing a little, I know. It reminds me of Dr. Cog. What's Dr. Cog? That was, in early 1990s, there was, I was in Denver, and they had Denver Regional Chamber of, what was that? Denver Regional Committee on, I don't know, Denver Regional Committee on That was something like that, and it was about Denver International developing the area. So they were the committee involved, developing Denver International Airport, and I mean now if you fly to Denver, you arrive in DIA, but even until early 1990s, the main airport was Stapleton International Airport. It was still International Airport. Although no plane arrives in Denver from Europe or from Asia, right? But it's still international because from Canada, planes arrive in Denver from Canada and from Mexico also. So that was still, but they Stapleton was a beautiful airport, but they built, bigger airport. I believe Stapleton Airport is now regional airport. But that because whenever I see cogs, that reminds me of Dr. Cog. Okay, anyway, so CGS, right? Gross marginal gross profit, right? Gross marginal gross profit. This expenses, OPEX, that's operating expenses. Of course, depreciation is part of the OPEX, right? Remember, back here. Actually, operating expenses. Rent, utility, salaries, depreciation, marketing expense, R&D expense, things like that. R&D. So, and again, we talked about depreciation last time. Depreciation is source of cash, right? You remember? Because it's a hollow shell. It's just making you it's just creating a hollow shell for increasing expenses. Then if you increase expenses by $1 million, right? By depreciation, which is not actual cash expense, that makes your EBT smaller by 1 million. So you pay taxes less. It gives you a tax shield, right? So it's actually cash preserved, cash not spent. So depreciation is always a source of cash. Okay, this is something that people generally don't understand. Depreciation is a source of cash, and EBIT. Then if you subtract all that, that's EBIT. Pay interest, so EBT. Pay taxes, net income 1,000. Now let's look at cash from by activity, operating activity, investing activity, financing activity. Let's break it down. So cash from operating activities, that was net income of 1,000, depreciation of 500. That's the source of cash, right? Net change in current account, 600, negative. So cash from operating activities is 900. So what is the current? Current assets, current liabilities, right? So in the current account, in the current assets, there was receivable of 100, inventory decrease, payables increased by. So if receivables I told you current the accounts payable is source of cash, but and then this 100 receivable, that is by the end, right? Accounts accounts receivable decreased by 100, right? If account receivable decreased by 100, that's a source of cash. Okay, because accounts receivable means what? Um, um, you didn't receive cash. You didn't receive cash, right? You didn't receive cash. That's what accounts receivable means. So if it decreased by 100, that means 100 you received in cash. So receivable source of cash 100. Um, accruals also mean source of cash because you didn't pay it out, but it's just like the hollow shell. It is uh, recorded in the statement as if it has been paid. So it is a source of cash, and then it is use of cash. I'm sorry, it's use of cash because um, if accruals went down, if the accruals went down, it's the use of cash, right? If the payables increase, that's the source of cash. So take a look. Accounts payable, we know, increased by 600. So that's the source of cash, right? And then inventory, we know inventory decreased. Oh, increased, I'm sorry. We know inventory increased. Uh, so that's, if inventory increased, that's use of cash, right? It's use of cash, of course, because if you have more inventory, you used cash, right? Accruals, obviously that looks like decreased accruals. It decreased, so that's use of cash. So if you add them up, then you have negative 600. So net change in current accounts 600, right? Then cash from investing activities, you purchased fixed assets, so cash decreased, right, by 2,000. So let's see. Fixed assets, gross fixed assets increased by 2,000. That's use of cash. So cash decreased by 2,000. Financing activities, increase in long-term debt. Long-term debt increased by 1,200. That's source of cash because sale of stock, source of cash. Dividend paid, use of cash. So add them up, 1,500, right? And the equity and cash account, net income increased by 1,000. Sale of stock, 800. So when you sell stock, cash comes in. When you pay out dividend, cash goes out. So adding all of this, right? Total change in equity is 1,300. And you understand net profit is, cash generated by operating activity. I mean, it's equity generated by operating activity, right? Remember that there are two types of equity, right? One, there are two types of equity. One is, paid in capital, right? Or paid in. Paid in equity, right? This is, equity, generated by sale of stocks. And then equity generated or internally generated equity, or equity generated by or from operating activity, which is what? Net profit. Net profit belongs to the shareholders, the owners, so it's equity, right? So that's what it is, talking about. So, and the so equity account and cash account, beginning cash balance, net cash balance, ending cash balance, right? So here, you can see beginning, ending, right? Change in cash balance, right? When we reconcile all of that, this is the reconciliation of all of that. Cash from operating activities, 900. Cash from investing activities, negative 2,000 is cash outflow. Cash from financing activities, cash inflow, right? 1,500. Net cash flow, 400. And the beginning cash flow is, and this net cash flow comes from beginning cash balance of 1,000, net, and then ending cash balance of 1,400. So cash flow is 400. So this way, this explains, reconciles all the, all of these accounts. And also you can see this 900, right? And then this is, think about it, negative 11, right? And then negative 1,100, 1,500, it has to be 400. You still arrive at net cash flow of 400 from all these activities. And then just simply by comparing beginning cash balance and ending cash balance, you arrive at the net cash flow of 400, right? So cash flow statement is all about reconciling, reconciling the cash balance, the net cash flow from the cash balance with all of the cash flows from the activities, right? Three activities: operating activity, investing activity, and financing activity. So that brings us to the free cash flow. So then just because we have this net cash flow of 400, is that free cash flow? What is the free cash flow then? It's defined verbally in many ways: cash generated beyond reinvestment needs, right? Cash generated beyond reinvestment needs, right? Or net cash flow less non-operating cash requirements. Net cash flow minus non-operating cash requirements. What is non-operating cash requirements? Replacing worn out fixed assets. So that's, depreciated portion of the fixed assets. But the verbal definitions are not not airtight. I mean, it's not like it's gonna be there all the time. Verbal definitions are always fleeting, so we need to always define it by. We need to define it by mathematical definition. We need to define it mathematically. So free cash flow is defined this way: operating cash flow minus investing in operating capital. Right? Operating cash flow minus investing in operating capital. What is operating cash flow? EBIT minus taxes plus depreciation. That's operating cash flow. Right? Think about it. EBIT minus taxes, you all remember. Let's take a look at this again. What comes after EBIT? Interest, right? And then what? And then it's called EBT, right? Because interest is out, right? This is out. EBT, which is taxable. Now taxable income, you pay taxes. Then you arrive at EAT. But EBIT is also called operating profit, right? Operating income or operating profit. And then first of all, taxes, you can't avoid this. This is off limits, isn't that right? You cannot touch the taxes. This is not, taxes are not something available to you. It's untouchable. It's off limits. Right? It's off limits. However, interest is optional. In other words, interest payment is optional. What does that mean? Oh, you may not have any interest payment. If you don't have any debt, you won't have any interest payment. Right? Even if you have debt, if it is really urgent, you may default on interest payment. So interest is basically, not as strictly unavailable like taxes. This can be part of your cash flow. So of course, continuously defaulting on taxes is, continuously defaulting on the interest payment is, detrimental. But a couple of times, if it is really urgent, you can skip. Later you can pay back. So the point is, from EBIT, you must at least subtract taxes because that's not the cash flow available to you. But again, I've been telling you over and over, depreciation is cash preserved. So it's cash available. In other words, this is a source of cash, right? Okay, and that's called operating cash flow. So this can get a little confusing. What do we call this? There is no lack of any better term. I would call it like this, for lack of any better term. But there's no exact term for that. It's just EBIT minus taxes. for lack of lack of better term, or for lack of precise term, or better, for lack of precise or better term, we'll just call it EBI. Now that's operating cash flow. What is then, we must subtract investment in operating capital. So think about it. Subtract investment in operating capital. What does that mean? Investing in operating capital means, your plant and equipment depreciates, wear and tear, because it wears it. And depreciation doesn't mean only, simply, the value of these assets goes down, not only because of age. Of course, with age, with wear. But think about it, wear and tear, that's a physical reduction in the production capacity, right? Wear and tear is a physical reduction in the performance of the plant and equipment. When the machine wears and tears, its performance goes down. If the production equipment wears and tears, its performance goes down, meaning its production capacity goes down. If the production capacity goes down, naturally it will have to be the value should be lowered, right? In other words, the value of the new machine cannot be the same as old machine, not only because that is old. Old machines are less productive, right? Older machines are less productive, so that the value should be lower, right? But then the next question is, are you going to leave it at that? Are you going to leave it at that? If the production capacity of your plant goes down, this is a serious problem. With the lower production capacity, your output will be smaller. If your output is lower, your revenue will go down. And if your output is lower, your market share goes down, right? Lower revenue means lower market share as well, right? So nobody will just, do nothing. Nobody will just watch it, nobody will just watch it go down, production capacity go down. Without doing anything. So what do they do? What do you have to do? You will need to replace the depreciated portion of your capital, right? So obviously there will be an investment. So think about it. Replacing, so which includes, change in fixed assets and change in net working capital. Now think about it. What does this mean? Change in fixed assets. What that means is, there are three things. When you need to do one of the three things, right? Why isn't it? Okay. At least, wow, that's too big. replace exactly the worn and torn portion of your fixed assets, or expend. Second, expend. 3, totally a new venture, right? So you will do one of these 3 things, right? So current production capacity, current equipment are basically designed for certain type of product. You can continue to produce the same product, but you want to maintain the current production level, then you will replace exactly the same portion that has depreciated, or expand, increase the production capacity, or you go into a completely different product line. That will require a lot of existing equipment may not be usable anymore for the new product, or maybe it can be modified, but whatever, it's going to be a new venture, right? It's called new venture. So and then obviously there will be a change in the fixed assets, right? Especially if it is expansion, right? If you're expanding it, there will be a positive, right? New venture, there will be a huge, great number, not negative number, positive number. That's what. And then the dollar amount will be positive, right? The change will be positive. Positive means the change will be positive, right? And then net working capital. What's net working capital? Change in net working capital. I've been telling you, current assets minus current liabilities. That's net working capital. But the change in net working capital means change in current assets minus change in current liabilities. Of course, net working capital needs to be positive all the time. I mean, if it is negative, that your business is not viable. This has to be so this has to be greater than 0. In other words, positive, right? But all of this, think about it. This number is positive, right? This number is positive. And this number is positive, right? So where should it come from? It has to come from this. It has to come from this, right? It has to come from operating cash flow, right? That's why then if you have something left, that's free cash flow, right? So the free cash flow, right, is operating cash flow minus investment in operating capital. Okay, and it has to be positive, right? And a company that doesn't have positive free cash flow is a company doomed. All right. I guess that's all the time we have. That's all the time we have. Any questions so far? Any questions? Any questions? Anyone? Any questions? Well, I'll take it as no. So then, Candice, did you have a question, Candice?
No, I was just going to speak up and say no so that nobody else had to.
Okay. All righty. All righty. All right. Then I'll have to call it a night. Have a great evening, everyone. Don't forget the quiz 1 is starting this Friday. All right. All righty. Good night, everyone.
Good night, Professor. Good night.
Good night,
Thank you,
Imani.
Professor.
Good night, Candice.
Good night, Professor.
Good night, Awa. All righty. Good night.
Good night.
Yeah. Good night. I'll stop recording.